Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started. Welcome to another episode of Kaizen Time. I'm joined by Eric Jorn, a partner here at the firm. What's going on, Eric?
How's it going?
Oh, it's going pretty good. We've talked about S-Corps quite a few times, and their taxation is a little bit different. So can we go into that? Because a lot of these are coming from LLCs.
Yep.
And now that change is pretty drastic.
Yeah. Well, so it can become a very confusing topic because with an S corporation, you create a whole new separate tax entity. You know, we have our S corporation that's sitting out here, but our taxes for our S corporation are really intertwined with our personal taxes. And that's where things get confusing. It's not like it's a C corp where it's got,
it's like its own life.
It's in its own world. Yeah. So an S corporation, you're going to have really two components to it. You're going to have profit and you're going to have owner's comp. So my owner's comp, I got to pay myself reasonable compensation on a W-2. Reasonable compensation is what the market would pay somebody to perform the tasks that you're doing for the business. Okay. So the IRS regulations say that's how you need to pay yourself as an owner providing services back to my S corporation. So that's the owner's comp portion. Now we have our profit. So at the end of the year, we prepare the S corporation tax return. We have profit at the end of the year. That then translates to a form called a K-1. Now, K-1 is almost like your W-2 for your business.
So,
right?
So just to pause quick, profit is like almost like its own, treated as its own entity in many ways. Like if it was a client, or not client, it's almost like an employee. It's just you are a separate thing.
So the S corporation really is just a measurement of profit. Like how much profit do we have out of this S corporation? Mm-hmm. And once we know what that profit is, we take that profit on over to your personal tax return. And we're going to put that on there as income for the business, regardless of what you took out for, say, profit distributions, right? We're taxed on the actual net profit of that business. And that goes on my personal tax return, and then I'm taxed whether my personal income tax rate is 12% or maybe 35%. It all depends on my whole entire personal financial picture. That's one of the reasons why we like to prepare the personal returns for the shareholders of an S corporation, because if we want to do tax planning, we need to understand what your personal tax rate is. It's not a fixed rate. It's variable based on what your personal income tax brackets are. We do planning sometimes, and what can happen is, hey, I also got this new source of income, or I sold an asset and I didn't tell you about it. And next thing you know, my income is double than what we created a projection for. Well, again, this one and this one have to be factored together, your personal and your business. They need to be factored together. Now, I'll circle back to profit distributions. One of the biggest questions I get is, so if I take a distribution from my business, is that taxable? And 99.9% of the time, it is not taxable. What's taxable is the profit at the end of the day for your S corporation, unless I take out more profit distributions that then I have what's called basis for. So I'm going to step back and we'll talk about this basis concept. So
That's exactly what I was going to ask you about.
And I'm going to make it very simple. So basis essentially is the equity you have inside of your S corporation. So equity comes in a few ways. I contributed capital to the business, so cash, assets, whatever it may be. And then how much profit have I retained inside of my business?
Liquid cash you just have on hand.
Exactly, right? So at the end of the year, again, I'm taxed on profit. So I pay tax on that profit. Now I got basis. So say I put $100,000 in the business to get it started. I got $1,000 of initial basis that I contributed capital for. And then now I got $100,000 of profit. I got to pay tax on that $100,000. Now I have $200,000 of basis. And then I drew out, say, $30,000 to pay my tax bill. Now I got $170,000 of basis, but I'm going to take another distribution to reward myself, and I take another $200,000 out of the bank.
There's a lot of moving pieces right now, Eric.
So we started at $200,000 of basis, so it paid 30 in taxes. So 30 comes out as a profit distribution to pay my personal tax bill. Even though it was generated from my business income, it's still a personal distribution to pay my business tax bill.
Okay.
And then I took out another $200,000 because I need to go buy a new house.
Okay.
But I only had 170 left in basis because I had to take out that 30,000 in for my tax payments. So now I have what's called excess distributions, meaning I didn't have basis to take that money out. More than likely, I went out and got debt. And I took that debt out of my S corporation and put it in my personal pocket. Now I got to pay capital gains tax on that excess distribution that I took out of the business. So that's the one time when distributions can be taxable.
So don't do that.
Yes. Well, no, that's why we plan, right? That's why we do planning to make sure you don't get yourself into that position. And that's why we don't get too greedy with, say, accelerating depreciation, because
gives you leverage, right?
Correct. Correct. So we want to make sure we retain basis and we don't get too crazy with some of the things that we're doing in the business just to avoid paying taxes.
Well, avoiding taxes, I think, as you said, is not how a business does well, right?
Yep. You run a business well first, and we'll deal with the taxes. We'll maximize your tax benefit.
So, is that really it? This K-1 form is basically the bread and butter of the whole S corporation
on the federal side, and on the state side. Now we can link another episode where we talk about pass-through entity taxation. It's added a new little wrinkle. Now we got state taxes we can pay at the S corporation level instead of at the personal level. Just a new little wrinkle that's been added. We'll share the details on that. But
we should say it's better this way, like this new.
It's more complex. I don't know if I'd say better.
Okay. Complexity typically isn't better in most situations.
Yeah. So this all spurred from the Tax Cuts and Jobs Act back in 2017. They limited your state tax deduction to $10,000. Well, here in the good old state of Illinois, most of us are paying that for real estate taxes alone, let alone the state tax we'd pay for our business profit. So we all lost out on a pretty good deduction that we've always had here. Well, that pass-through entity taxation now brings that back, and we can pay it through the business, get the tax credit for it. And it can save. Illustrated a couple topics where, say, I have a $300,000 business, I pay the 5% pass-through entity tax. My federal tax rate's 33%. I'm saving $5,000 from just paying my state tax through my business instead of personally.
Eric, quick question as we wrap up. You're an S corporation. When should you stop being an S corporation?
I'm an S corporation. When should I stop being an S corporation?
When should you make a transition away from that? Like, is there a magic number, or is there something where you're just like, no, this is the clear sign you're ready to move? Yeah,
no. So they're in the life cycle of a tax entity for a business. I don't feel like S corporations really graduate. So now where you get yourself into some trouble is, say I'm starting a business and my intention is I'm going to bring in investors.
Okay.
Well, an S corporation is a little bit harder to do that because, say I start a business and I have an S corporation, I'm sole shareholder.
Okay.
I start making a lot of profit. So I start making a lot of profit. That's why I became an S corporation. I don't want to pay that FICA tax. I want to save a little bit more.
Okay.
But now I want to start bringing on investors and grow this thing into, a nice big organization. Well, now I have to sell individual shares to bring other investors into the business. Taxable transaction to me to do that. I'm limited in who I can bring on as shareholders, and I can have up to 100 shareholders in an S corporation. Now, if I'm a partnership, right, I can bring people into my partnership without incurring tax.
Okay.
There's a lot more flexibility in a partnership world. That's why you'll see as private equity firms, they're generally organized as partnerships because of the flexibility from the investor standpoint. And then you'll see another episode that we've had on 1202 exclusion for C Corps. So C Corps are popular, especially in the startup realms where people might exit, say 5-10 years after they start a company, they build something cool, interesting, and they sell it off. There's this 1202 small business stock exclusion that you can get. So if your goal from day one to start a business is to
Grow it and sell it.
Maybe a C Corp, we might pay more tax up front, but then when we sell the business down the line, we could theoretically sell it tax free.
But that's basically got to be part of the vision, right? You got to understand and have it planned, as opposed to, hey, I'm a small business. I got this from my family. That's not the.
Yeah. If you want to reorganize an S corporation into a different entity, it's a complex and expensive transaction.
So S Corp is definitely kind of an end game thought process.
It is. It's why we preach entity structuring during the initial startup of the business is so important, or before you hit that pivot point where your business really takes off and you say, hey, my business is about to take off, and say, okay, what's the grand plan? If my business is about to take off, what's my grand plan for this thing? Mm-hmm. I mean, a lot of times it is, hey, I'm just going to milk this thing out and then sell it at the end of the day. And S corporation is more than fine to do that. Mm-hmm. But again, if you want to start bringing in a lot of people, I want to do some creative, more interesting things from my structuring standpoint. You might want to pivot earlier than later.
Well, the larger it is, the more difficult it is to wield, right? All of a sudden you got a ton of moving parts. It's better to do it when it's
small and controllable.
Yep.
And the dollars don't get too big because, again, we're talking about a taxable transaction to get out of an S corporation.
That's what I wanted to hear. Perfect, Eric. Thank you so much.
Thank you.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.